Okay, so this panel is about payment practices in the grocery, retail, and food and beverages industries. Well, it's not only about that. We're going to look at some general aspects of supply chain finance too. But it's an interesting area because in traditional factoring, this is not an area that is liked very much by finances, and they tend to stray away from it. So we'll be looking at the peculiarities, shall we say, of this sector and what's happening here in terms of supply chain finance. So let me introduce our panel. Let's ask them to introduce themselves. Shereen, please say hello and introduce yourself to the audience. Thank you.
My name is Shereen Elansary. I'm working with QNB ALAHLI. It's a bank. The group is located in Doha, Qatar, and our subsidiary is in Egypt. I've been in the corporate for around 30 years now, and currently I'm handling the supply chain finance at the bank.
Andris?
Andris Krasovskis. I'm a corporate finance director with the Food Union Europe. That is the European part of the global dairy and ice cream company. In Europe, we are operating in 6 countries, roughly 300 million euro turnover. One of the areas which I'm responsible for is dealing with the capital providers to our group, and also I'm overseeing the treasury function in the group. So in that sense, we are on the both sides of the supply chain finance, both as a buyer and as a supplier.
Kristaps?
Yeah. Hi, I'm Kristaps Velmers. I'm representing Citadele Bank. It's a local Latvian located bank, but we are operating in all 3 Baltic countries. And I am factoring project manager there, responsible for all the financing through the factoring.
Uwe, I don't think we really need an introduction from you.
We might have a few new listeners online.
Okay.
So
please
just to
do.
be technically and politically correct, so I'm Uve Poom. I serve as COO at SupplierPlus, and I often interface with implementing our solution across industries, but retail in particular as well.
Okay. Well, let's start the session, and I'm going to start with you, Uwe. Tell us why this sector is perhaps a little bit different. What are the peculiarities about this retail sector, where you've got perishable goods, groceries? These are the kind of products that in traditional factoring, they're not liked very much because you don't want to be financing invoices for perishable goods which might be returned. And then you're, as a financier, you're left exposed. Just give us your insights about this.
Sure. So I would say that, regular factoring does cover suppliers in the retail industry. And in that respect, it's not that, it's entirely avoided, but what is absolutely part of the territory there is that you have the advance rate of, say, 80-90% that is paid out to the supplier. And then the reserve is left, for any set-offs or delays that that supplier might face, or rather the bank might face. And as a result of these set-offs and potential delays that are quite frequent in retail, especially because of what you said, there are returns, there might be insufficient or delinquent goods. What is also quite important is that retail chains have marketing services that they offer to the suppliers in turn. So whether it's the little leaflets you get in your post box or shelf fees. So banks need to safeguard themselves against any deductions, obviously. So this is why the reserve is necessary. And maybe in other industries, let's say in construction, the company or the customer that has ordered a project typically signs an acceptance act, and after that you don't have any disputes. You have your 60 days payment period. It's quite safe to finance also on a non-recourse basis, so the supplier doesn't have to be accountable for any deviances in the payment. In the retail industry, that type of safety or comfort doesn't exist. So you really need to, as a bank or financier, keep your eye out on the set-offs and structuring these irrevocable payment undertakings as a buyer in retail is also complicated exactly because of the set-offs, right? So this is something that complicates the matter. It is something that is entirely manageable with precise use of technology, but it does take implementation that is far deeper than in many other industries.
And Andris, tell us how this works in practice, because you're as you said, you're on both sides, supplier and buyer. A lot of people looking remotely on this setup would say it sounds quite complex and quite difficult, but does it work smoothly in practice?
It does indeed. It is complicated, and one comment though I must make is that if we look at ourselves as a supplier to retail chains, the perishable part of the question is actually not there, because when we sell the products, we sell it, and if it's accepted, then usually the retail chains take the risk of goods going beyond their normal due date. But in general, there's still a lot of other obstacles, as outlined by Uve, in the game. First of all, it's when the goods are delivered to the usually distribution center of the big retailers. If there are certain inconsistencies with the actual state of the goods and what is in the invoice, what happens usually is that there is a special note made that is returned with the delivery agent back to our factory, and based on this note, the initial invoice is cancelled and the new one is issued, and the new invoice is usually electronically sent to the retailer and physically with the next shipment. But quite often, and especially if we talk about deliveries happening before the weekend or over the weekend, this is being delayed, and the new invoice is issued only after several 3 or 4 days. And the next level is when the inconsistencies are found at a later point. I don't know, within the big batch of products delivered, there are certain goods that are not supposed to be there, or they are not in good condition. Then basically this issue is raised usually with our key account manager, and when everything is investigated and confirmed, usually it takes around 1 to 2 weeks. We issue a credit note to the buyer.
Okay, and by the way, if there's any questions from the audience, you don't need to wait till the end. Just raise your hand, and we'll be happy to take those at any time. Shereen and Kristaps, so the comparison with traditional factoring, obviously you've got the buyer undertaking, which you don't normally get in traditional factoring, which helps a lot, of course. But even so, you've still got credit notes, set-offs, all these things flying around. Shereen, in practice, does it all go smoothly for you, and do you sleep at night, and are there any ongoing worries that you have with these kind of arrangements?
You mean for the returns and this?
Yeah, from a financer's point of view.
Yeah. For the factoring, of course, the invoice, in order to be paid, the buyer has to accept the goods, and they should be in the agreement that they sign for acceptance. Also, normally the factoring company, we take like what we call a waiver for all potential defenses. This is in the normal sort of business. However, there is another practice within the bank, other than the factoring, the supply chain finance inside the bank, where we deal with small retailers and finance them paying for the big suppliers. I assume here that the main issue is the relationship between the small retailers and the suppliers or the distributors. It is well known that such goods, they can return part of the goods. Some, if expired, the supplier, they just pull out the products. This is what happens. But again, sometimes they involve the financer in the commercial fight or problems, and this is what we have to be aware that to get outside of all these complications. We had a case at the bank, just the buyer just got they didn't go into a legal case. It was a commercial thing, but they just don't want to pay back to the bank. The most important issue here is to keep the bank outside of any commercial disputes that may take place.
Kristaps, you're new to this, to supply chain finance, I think, your bank, but you've personally got experience before, and also with traditional factoring. Do you have any comments to make about these particular structures?
Yeah, actually, previous speakers already mentioned about the issues in retail and grocery, especially business, when it comes to credit notes, returns, etc. And we understand this market, and since it's quite big, we are looking into solutions. Currently, we are working mainly with the regular factoring, and we know mostly how each of the main grocery retailers are operating, how they handle these parts, and we are adapting to that. And actually, one of the basic things how it's usually handled if there is a credit note is what Uwe mentioned. It's a reserve, what is left, but sometimes it could be a case that it's not sufficient, and then it's a reconciliation to the seller, the producer. Yeah? And in these terms, it comes how well we know both parties, what are the companies, and if we can trust both of sides, it's not a big of a problem. And we are not so afraid of these transactions. But,
So, Uwe, tell us how technology can make life easier for these guys within this sector, because it isn't as simple as some other sectors to deal with. What can technology do? What can your platform do to make things easier?
So maybe the comparison to construction is again sort of a good illustration. So in construction, it's straightforward. The services have been rendered, something has been completed, the acceptance act is signed, there is one invoice. It could easily be a 6-figure invoice. You finance that, you get the irrevocable payment undertaking in the process if you're lucky, and this process you can sustain manually. Now, when it comes to retail, it's kind of the exact opposite. So the number of invoices is tremendous. The number of suppliers is tremendous. Depending on the exact setup, the entire credit note issuance process can really complicate the matter. There could be several persons or moments involved in the approval process of the payables, from receipt of goods in the warehouse. Then somebody in the financial department might have to approve payments as well. In case there is a credit note, then key account managers get involved. So you can already see the complexities that get in here. Now, on the other hand, it's not exactly a particularly creative or subjective matter. So what I'm trying to say is that for the most part it is automatable. Of course you have some legal disputes with the suppliers, and these, you know, you need a highly subjective court of law that steps in. But to be honest, this is in rare cases. It's really the deductions and the basic calculations that need to be administered. And in other words, you could you know, step in with technology and start doing the calculations. So it's at that point really about how you design the processes of accounts payable approval, about credit notes issuance. From then on, you need to pay attention to what for the financier the buyer is ready to approve. So any potential set-offs can be set off from the approvals. So this is in case you are already using reverse factoring in the process. In case you're not, then you would be doing the set-offs from the amounts that you are about to pay the supplier directly. But you need to, you know, just pay attention to the processes, maybe adjust them a little bit. But of course, we try to make sure that the adjustments are minimal, because you know, the moment you mention SAP integration to someone, then they have an allergic reaction to it. So it is our job to kind of work our solution around the needs of the trade partners and the financiers, rather than expect anything to the contrary. And I would say that this type of expertise and, you know, knowing intimately the processes of the buyers, this is something that we really focus on. And we should also remember that buyers have very little appetite to go through the same process with multiple financiers. So they want to design one system, it has to scale across multiple financiers, and then that's how we can really get the ball rolling, and that's what we do.
Mm-hmm. So when you built your platform, you had this sector in mind, as well as other sectors, of course, but you wanted to make it easier and attractive to this particular sector.
Yes, absolutely. So, Co-op Supermarkets was the first, among the first customers that we started to finance here in Estonia. It's one of the largest supermarket chains, and in that respect, it's really bread and butter. In, you know, let's say Western European markets, supply chain finance is a mainstream thing in retail. So, so it's really kind of the first area where the solution is adopted, as long as the, you know, economics make sense. So we are absolutely keen on making this a standard operating procedure in the Baltics as well.
Sure. Okay, let's look at the financing of the supply chain specifically. And of course, in a supply chain, you can have very large suppliers, medium-sized suppliers, small suppliers, SME suppliers. And of course, raising finance for SMEs has for a long time been an issue. This funding gap that is often spoken about, it's still there, and there have been lots and lots of initiatives over the years to try and close this funding gap. But it's still spoken about a lot. It's still an issue, and small businesses still struggle to get finance. And in fact, just to give you an idea of how far back this goes, in the UK there was a committee formed called the Macmillan Committee, which was a government committee which was formed specifically to look at this issue and to try and do something about it. This particular committee was formed almost 100 years ago. So it's still a big issue now, and it's still something that needs to be addressed. But of course, with supply chain finance, with factoring, these are solutions which help a lot in this situation. And with SMEs in particular, you know, raising finance is an issue because very often the only assets they have, or the main assets they have to use to raise finance, are their receivables. And if a small business goes to a bank and says, you know, I want an overdraft facility, I need some working capital, all I have is my receivables as an asset. Typically with an overdraft, the bank may provide credit in terms of those receivables. It will, let's say, provide an overdraft based on the value of those receivables up to about 50%, something like that. With supply chain finance and factoring, you'll get much more of that. Factoring typically around 80%, and with supply chain finance it can be around, or usually around 100%. So, Kristaps, tell us a bit about that from your point of view as a financier, about this issue for funding SMEs. Talk about it from your region, if you like. How do you see this problem? How do you see what you're doing as improving the lives of SMEs in terms of raising finance?
Yes, of course, we see this as an issue because, as it was mentioned, there are so many suppliers, especially to the retail chains, and a lot of those companies needs financing. And when it comes to especially not very mature companies, even though they are small but still not very mature, it is an issue when they approach bank. First, as you mentioned, yes, the structure of the balance sheet, whether there is some hard collateral, which banks usually prefer, especially for SMEs. In most cases, there is not such asset on the balance sheet, and that's why we are looking into different solutions. Of course, currently, one of the solutions is regular factoring, when to some extent we can, of course, rely on the debtor. It's a big retail chain, then of course it's strong debtor, and that's how we can increase this level of financing. But still, not always it can work, because of course it means that every single supplier of this particular buyer will come to the bank separately. It will be so many cases on the table and that will need to be negotiated not only between us and the client, but also between the client and the buyer. Separate document packages for each, and of course, it creates a lot of nowadays maybe less, but still paperwork, evaluations, etc. And yeah, these are the main issues. And currently, also what SupplierPlus is offering, it's also as a solution of that there are less work to be done, because if there is one buyer, there is already a specific structure for everyone. And it's possible to spread around. But otherwise, yeah, it's case by case, evaluated, understand, can we do that, can we not do that, and yeah.
Can I jump in for a second for the sake of a lively discussion here? So insofar as you can tell, how much have you had discussion with your colleagues that, why do we even need this factoring or reverse factoring? We already have overdraft, this is doing a fine job. And then from then on to conferring that you're beginning to cannibalize your corporate banking or regular factoring lines when it comes to supply chain finance, or vis-a-vis supply chain finance.
Yes. No, actually, if you look from ease of use, of course, credit lines, overdrafts are much easier to use, but on the other hand, the legal background of both of the transactions are a bit different. And when it comes to factoring, it's more secure because we take over the debtor directly, this invoice, not like it's just a collateral on the balance sheet. If you look already on supply chain financing, how can we switch to that? It's relatively new in the market, and all the participants need to adapt to get to know much better, even though, of course, there are other financial institutions who are more aware, or people who are more aware, but still the market for that is quite new and need to get in that. But I would say that at one point it will switch quite rapidly.
Andris, from a buyer's point of view, you've got, I don't know how many suppliers in the supply chain, maybe a large number, some of which may be very small, but some of those very small suppliers may be very key suppliers. So how important is this for you, is supply chain finance in keeping the structure and rigidity and of your supply chain in place, as I say, some of which may be very key suppliers to you, but also comment on the fact that you may want to improve your own working capital position as a buyer and extend the payables position.
Yes, I can probably take an example of our procurement of raw milk, which we procure a lot in Latvia and actually also in Estonia and Lithuania. Our production base is based in Latvia for that. And we procure from a large number of farmers. There are a few larger cooperatives, but still a lot of small suppliers, I would say. And one way in which we try to differentiate ourselves from other players in the dairy is that we are a reliable partner that tries to help our suppliers. We commit to procuring and getting all the output they can provide to us, so they can be secure that all the raw milk that they have will be bought from us. This sense of security is very, very important for this type of suppliers. And also payment on time is absolutely critical for these suppliers. We have built our reputation around that we are always on time. There are no delays. We always take the quantities and pay for that. But having said that, of course, we understand that implementing a supply chain financing platform would be beneficial for a lot of these small players because of the reasons mentioned before. And in the meantime, it could also be beneficial for us as we can extend our payment terms. This is an ideal win-win situation. The only aspect I can raise is that usually especially the smaller farmers, they're not so sophisticated in finance and financial matters. So they are interested in getting paid on time. So it takes a lot of education, explaining to them what supply chain is. And quite often when you approach them initially, and usually banks do approach them, or they hear from somebody else about factoring, and the first reaction from them is your buyer in trouble? So that in that sense, with the help of SupplierPlus, I think what we will try to do is we will try to go out and talk to these farmers and try to explain to them that this is indeed a win-win situation for everyone, and all the parties can benefit from it and try to implement it.
I mean, do you ever get the situation where you say to your suppliers, well, we want to introduce a supply chain finance arrangement. They presumably know that you want to extend your payables, but for some of those suppliers, there's going to be a finance cost attached to that arrangement, which they wouldn't have had before. So is it always viewed as a win-win, or do some suppliers not like that
depends again on the risk appetite of the supplier. Certain suppliers are quite conservative and prefer not to have any leverage at all. Some of them use, as we discussed, credit lines or overdrafts, which quite often are more expensive than the supply chain finance arrangement. So if we are able to show them this in facts and figures, then I think there is a certain amount or percentage of the suppliers that would go for it.
I would also specify that, I mean, working capital always has a cost to it, whether it comes through a payables finance structure or an overdraft or owner's equity. You just need to kind of reveal that, or X-ray that. And then once the cost is more or less on par, then you simply say that, guys, now you can conduct a true sale of the receivable. It's an off-balance sheet solution for the supplier in that respect, and you don't tie up any of your own credit limits. You don't need to even open up a credit limit. So at that point, the offering becomes so compelling that it's difficult to resist, but it does take a little bit of educating.
Shereen, tell us about your bank's view on financing SMEs, particularly in these receivables finance structures? How important is that to the bank? Is it very profitable? How risky do you see it?
Okay, if I may just add to the previous point, when we are doing the reverse factoring, it's the same like we're paying the supplier. On the other side of the equation, sometimes we're paying the small clients that are buying from the big suppliers. Both sides they benefit from this supply chain by getting the benefit of like dealing with the bigger entity, the other side of the equation. I mean, if we are financing a small buyer, so we give him the privilege that he's buying, and we are taking the risk of being paid by the bigger supplier. So we give a benefit either to the pricing or to the tenor. We're replacing the supplier facilities in most of the time. And for the reverse factoring, it's the same. Small suppliers, maybe on their own, they would get at some tough conditions from banks. So here the win-win appears. For QNB ALAHLI, I was just telling my colleagues now, we have been very active in the SMEs. Maybe some of you know that there have been some initiatives by Central Bank of Egypt to encourage lending SMEs, and the initiatives, they were all concerned with the very privileged pricing schemes. We were the first private bank to achieve the first goal, which was 20% of the portfolio of the bank to be lent to SMEs. That was 3 years ago. And last year, we also achieved the 25% because they increased, central bank, they increased the target to 25%. We were almost the first private bank, aside from public banks. So we're really very, very active, and we have now a good reputation in the market. How we see the SMEs, it goes with the country's initiatives. There are a lot of trends now in Egypt to encourage those who don't have bank accounts to open bank accounts. There are also the financial inclusion initiative. We're simplifying things in order for individuals and for very small companies to get encouraged to open accounts, to get finance, to be on the system. Digitizing the process, again, we're trying to simplify things. So we're using at our bank a very simplified tool, which is payment through the QR with a smartphone. We can use credit cards, we can use overdraft. Although in the retail and the groceries, from experience, overdrafts and credit cards are not very practical for them. They are simple, they need to be trained, like we've been talking about education. The best solution is the very short-term loan, which is normally, according to their cycle, sometimes it's 7 days, sometimes it's 1 month. And this is more or less the average financing cycle. For us, as I said, we're very much for the SMEs, for microfinance. We've been very active. And still we have a lot to do with the market itself.
Okay. Let's have a quick look at balance sheet treatment, because this has been mentioned, I think, before yesterday. There's been some high-profile corporate collapses in the last few years, and that's really put the spotlight, I think, on the balance sheet treatment of these arrangements, whether they should be treated as payables or debt. Andris, what's your view on that?
From the perspective of the buyer.
Yeah.
Well, obviously, as a finance person for We do have in the group the financial covenants from the banks, and obviously the off-balance sheet treatment of such such arrangements is much more beneficial than the otherwise in terms of financial covenants.
Shereen, any comments from you on that?
For the seller, if it is with recourse, so it is still in part of it in the ownership of the seller. The point in going through this is to get rid of the trade notes. So without recourse, it's done that the bank buys the note, and it shouldn't be on the balance sheet of the seller. However, for the buyer side, I think it depends on the arrangement and the agreement with the bank. It depends on the kind, on the kind of guarantees given. If the parent signs a guarantee, a collateral in the form of any securities, then maybe it will be more on the loan or bank debt side. Again, what I know is it's up to the auditor's view within the legal framework. However, I think it has to be disclosed somewhere in the balance sheet. In any case, there must be a very clear disclosure.
Sure. Any other comments?
Yeah, maybe I can also add, of course, if you look from company's perspective, as Andris mentioned, it's important to how they treat these things and to improve balance sheet. From financier's perspective, of course, it's very important to know what is going under that. And it's very important that we know that actually there is one type of financing or another type, that there is third party to whom, for example, company needs to pay at some point, because sometimes such treatments, if they are excluded from the balance sheet or any other additional information, it can sort of kick back at one point if something happens. To some extent, at least in Latvian market, it's covered by official credit registry, where banks are reporting. It's obligatory to report any type of obligations. When it goes beyond the borders, then of course it's questionable, but we are trying always to understand the whole picture. Not only we see balance sheet, okay, it seems fine, but we need to understand actually, is there any trade finance solution used, and in what structure, and what it means. Yeah.
What's interesting to see from in an international perspective that as SupplierPlus we have is that banks, they need transparency for the obvious reasons. There's also a great push by the rating agencies to make it happen, because if you don't disclose the reverse factor claims, then you're kind of in the dark when you're assigning the rating. So there is possibly the ultimate scenario where reverse factored or claims, receivables or payables under payables finance projects programs will be disclosed on a separate line. So this is probably where the thing is going. In essence, I would argue that it is a bit different from a loan obligation, and it is a bit different from a typical trade payable. So this classification, at the end of the day, I think makes sense. And now what's curious is what the auditors make of it, and this really goes, let's say, country by country. So, in some markets, it seems as if auditors, the moment they smell a financing agreement for payables finance, they will say, hidden financing. In other markets, the corporation or the buyer and the bank can have a financing agreement in place, which is giving comfort to both parties. We know each other's limits, everything that that the maturity is involved. So it is quite healthy to have that in place as well, and the auditors won't blink an eye. So that really depends on where exactly you're operating.
Yeah. And I guess strictly speaking, I remember this point came up in one of our conferences a couple of years ago, when we had a regulator there who was speaking about this, and the banks were quite upset about some of the points he was making. And one point, I can't remember which bank it was, one point they made was that even if these arrangements are in place, there's no obligation for the funding to be utilized by the suppliers. So you could have a situation where the arrangement's in place, but there's no actual debt involved. So, okay. Let's move on and talk about the impact of the EU and national payment regulations. Andris, how's this affected you? Because you want to extend your payables position, possibly, and the effect of these national payment regulations may mean that you're constrained to some extent. Again, is this where supply chain finance comes in and can be very helpful?
Indeed, it very much depends on the size of the parties. Who is the bigger party in the trade? Usually, these regulations are basically making the position of the party that is bigger, that usually had the bigger leverage in terms of negotiation. Makes the position slightly worse. So for us, I mean, it worked both ways. In certain countries where we didn't have, where we're not sort of the dominant player, from the perspective of the supplier, we obviously got the improvement in our terms. From the perspective of the buyer, sometimes the situation worked vice versa. But all in all, I think it just again creates another. It's another catalyst for supply chain finance, both from the side of our clients and from our side. And again, understanding that this is a win-win solution. It just, I think, makes the environment more favorable for the growth of this platform.
What about you, Shereen, and Kristaps? I mean, this regulation effectively means that people are paying more quickly. Does that impact you in terms of your business and how much your income is affected?
Again, it has to be reflecting the cycle itself, the cash conversion cycle. However, the way we look at it is, yes, it may not be increasing the interest margins, but again, we look at it as a healthy line of facility. When the client borrows and pays back in very short period of time, he has the ability to replicate the same cycle again and again, and it shows the account very healthy. It gives the bank the amount of trust in order maybe to increase even the financing amounts. I think it's good to have short cycles that are successful rather than a longer one with more interest to be paid, maybe showing a less healthier account performance. Again, it depends on the industry. For the grocery, yes, it has to be short. It has to be short. But you can gain from other business with the clients. Yani it doesn't have always to be the borrowing itself. You have a lot of other businesses that you're creating with the client.
Sure. There's an interesting question from the audience here about compliance with this directive. I mean, so the question is, how is your experience on the implementation and compliance with this regulation in practice? Do businesses comply with it?
Yes, actually yes, and recently we also saw if, for example, we use trilateral agreement, supplier, buyer, and us as a financier, that these conditions are already included there. So it's, yeah, we need to comply, and we see that suppliers are doing, and they are understanding that, and also retailers are understanding. Of course, everybody is looking for solutions, maybe to extend, but yeah, they're following these regulations.
So I would also add that so on the European level, there's the unfair trade practices regulation or directive that has been now taking effect in member states. So on the 1st of November, if I'm not mistaken, all member states had to have it implemented. But national regulations to the same effect might have been introduced earlier as well. So in Poland, from what we have seen, the banking and retail companies have reacted simply by way of using maturity factoring or payment extension. So the same invoices are still involved. They are paid out to the suppliers on time, possibly using payables finance to pay them ahead of time. And then the buyer would assume the responsibility and the cost of financing, let's say, another 14 days or another 30 days. And this is again what I just told about auditors in different countries. The Polish auditors, from what we have been told, don't really mind if the buyer is covering the cost of the extra period and do not expect this to be disclosed as debt financing. So they tolerate that as a trade payable. So that's possible there. That there is another structure that in some member states will likely be used, because payables finance effectively allows the supplier to receive payment according to the regulated terms, while then technically the invoice can be longer than that, and then the financier will be waiting for the payment for the extra period. So there is a certain, let's say, arbitrage opportunity over there as well.
Okay, we're getting quite a few questions in, so I'm aware that we don't have much time left, but this is an interesting one. And I think this is probably aimed at you, Kristaps, and possibly you, Shereen. If you currently have a factoring operation within your bank and you're looking to introduce supply chain finance, is there an issue that you may be cannibalizing your existing factoring operations? Factoring operations tend to be more profitable, I think, generally than supply chain finance. Is that a concern for you, or was that a concern for you when you were looking at introducing supply chain finance into your bank?
Short answer is yes, of course, because we understand, and especially because the market is not very big in the Baltics in general. So we understand that at some point we will face that issue. But how we look on that, it's better to have this cooperation maybe in different terms rather than not have at all. So this would be the approach, the main approach, because yeah, that will happen, and it's happening.
But I should add that at the end of the day, the development of this product usually increases the outstanding amount of trade payables and increases the amount that is payable, because you can skip the reserve part. So we would argue that it ultimately ends up increasing the market size.
Shereen, do you do factoring, traditional factoring?
Yes, we have a factoring company. Yeah. We have QNB ALAHLI factoring. I see that it depends on the case, but when we introduced the supply chain at the bank, we were trying to complement the process. So if we're talking reverse factoring, we will be putting priority to the factoring company. If we're talking small retailers paying to bigger suppliers, then we go to supplier finance, which we call where I come from, B2B. The B2B or the bank finance, normally it's cheaper than the factoring, and that's why it might have a more attractive, might be more attractive to clients. It depends. If we are financing small suppliers to a big buyer, yes, we will go for the reverse factoring. Other way around, we will go to supply chain finance for clients. I think that both they complement each other, and we need both in the Egyptian market or in any other market, in my opinion.
I want to move on to onboarding within SCF and implementation. And I think this is an important area to discuss. Onboarding has been an issue particularly for the smaller suppliers, and the cost of onboarding. I think Sean, you mentioned this yesterday. How does that work, Shereen? You know, the cost of, very often in these arrangements, larger suppliers are onboarded, and banks often feel it's not cost effective to onboard the smaller suppliers because of KYC and AML requirements. What's your view on that? How do you do this?
Yes, you're perfectly right. It is costly. However, it depends whether they are a bank client. Many times we have the suppliers, even if they are small, they are bank clients. So the process itself of the KYC is done. For the new to bank, it takes some time. It takes a lot of resources, human resources. We are working, or maybe the regulator is working on the e-KYC, which should simplify the process a little bit. Also, getting the supplier list or the client list from a reputable client of our of the bank's clients, it helps the investigation process. It facilitates the onboarding. This is what we are doing now. We can rely a bit on our clients whom are giving us the names to finance. And hopefully we will have this e-KYC in the near future.
Okay, and Andris, for you, this could be an issue as a buyer. If some of your suppliers are not onboarded onto the system, how do you deal with that?
Well, so far, I mean, we are at the very start of building this supply chain as a buyer, and we have been cooperating with SupplierPlus, and the process, I would say, went fairly smooth. I mean, from our side as a supplier, as a buyer, we obviously know these suppliers. We usually work with a number of them. So from our side, there is no issue with KYC, or we obviously don't have to do this deep checks as maybe banks or financial institutions have to do. But the experience that we had so far with SupplierPlus, I would say, is good.
Okay, so you're using the SupplierPlus platform.
Yeah,
and
that's the only way.
Uve, I was going to come to you to explain why you do this a bit differently to other platforms, and why with your platform the whole onboarding process is actually made a lot easier, and you don't really have this issue of the cost of onboarding the very small suppliers. Can you just explain to us how that works and how you came to structure this and put this into your system? Which sounds to me like a really great way of doing this and handling the onboarding.
Sure, and this will be interesting to get your remark on this as well, how you view this as a bank, because there are, let's say, not mixed feelings exactly, but it cuts both ways in a way. So, you know, if a bank typically has to onboard a supplier under their supply chain finance program, the instinct is to use the existing customer onboarding process of, let's say, opening a bank account. That has its cost involved. What Sean mentioned, this 30, 40,000 euros, pounds, dollars, yeah, so annually, right? So we operate at a cost 100 times less, roughly speaking. So it's quite incredible. Now, why we are hopefully a bit more efficient in these matters is that we do not open a bank account. We do a lighter version of onboarding, which does, include KYC checks, sanctions checks, need to make sure that the individuals involved are clean. But the typical AML check is not a core part of what we do, which already simplifies the matter. The second thing is that we are a highly technology-driven, digital-only solution. So nobody gets to come to our office for onboarding purposes and signing agreements. Everything is done online, including identity verifications, and we have also designed our processes to be international. So we don't mind if the supplier is from abroad, other than we love to say Cuba and Iran. We have particular problems. Russia, we have nowadays serious problems in that respect as well. But we can eventually get hold of the information that we typically need to onboard the customer, and then, we do the legal, the compliance part, we do the human part of education, what this means for the suppliers. We can handle the customer support as well. And what our sort of value prop to banks is, therefore, is that we take care of all the expensive, inconvenient, time-consuming business of onboarding the customers. We do share the supplier data with the financiers because we know full well that you want to be and need to be informed of who is, the beneficiary of the financing. But as long as the bank is happy to outsource this to us, then that is entirely possible. And as a result, we become the single counterparty for the purchase of the receivables. So the bank now can skip all these steps, and as long as the internal regulations permit, then you're in the green.
Exactly. The last part was right on the point that if we are in line with regulations, because banks are really heavily regulated, and we need to follow all the KYC, AML questions, compliance, due diligence, etc. Yes, what could help is that if in this structure there is a supplier to whom we don't need to open an account, that could ease up this situation and the review, but basic things still remains. If we need to also open account and everything, then we need to do much deeper due diligence on the company. And the thing is that we cannot outsource that. It should be our internal. Yes, you could provide information, but we still need to do it, the evaluation by ourselves. We cannot just take your evaluation and place it as an ours. And yeah, that is regulated strictly, so we not follow that.
Yeah. I remember when we spoke about this a few weeks ago, I thought it was really a fantastic methodology that your platform utilizes for onboarding.
And I can add that we actually had one supplier of ours from New Zealand that used the SupplierPlus, so no borders.
We're nearly out of time. I think, but perhaps time for one more question from the audience, which I've got here, and that is, does the panel agree with Uve's view that aggregated multi-financier SCF programs are strongly preferred by corporates? Shereen, do you have a comment on that?
I didn't get the question, sorry.
Do you agree that with Uve's view that aggregated multi-financier supply chain finance programs are strongly preferred by corporates? I think there is a general trend in the industry for there to be more of this going on than there used to be.
Yeah, I agree that yes, it is very much required by the corporates.
Kristaps?
Also agree that yes, it's easier for them, much more sort of options to some extent, and yeah.
for cash management, for liquidity, for everything. And more than the money thing, it strengthens the relationship between the whole chain.
Uwe, have you seen this growing since you've been operating, or since SupplierPlus has been operating? Have you seen the demand for these type of arrangements, multi-finance arrangements?
Yes, so it again depends on the market development stage. So in, let's say, Poland, retail chains can have 7, 8 parallel programs running with different financiers. So then they need to streamline the approach. In the Baltics, where the market is, let's say, much more nascent, there aren't as many buyers who have a single line open, let alone who have evolved to the need of having multiple lines. But if you think ahead about 2 steps, then it will become very quickly evident that this is a wise idea to have multiple financiers open or financing your lines. And this may include, like, Citadele might not be able to onboard maybe a French or a Moroccan or New Zealand supplier. Then we need to find another solution to that particular case, even if Citadele is the primary funder overall. So these cases abound, and it's not a difficult sell.
I think we're pretty much out of time, unless there's any very quick last burning questions from the audience. I think we've pretty much kept the time pretty well. So thank you very much to my panel here.